Gold CEO and Chairman, Mr. Rudy Frank, and Jim Willie of the Hat Trick Letter will be presenting today. This will be the start of our new goldseek.com live series, which we hope to connect you with more of our authors and companies through this new format. As we begin today's presentation, we'll begin with Mr. Rudy Frank. Mr. Rudy Frank is a co-founder, chairman, and CEO of Seabridge Gold Corporation. Mr. Frank has had over 30 years' experience in the gold mining industry and has held directorships and senior officer positions in several publicly traded companies. Today, Mr. Frank will be presenting Seabridge Gold to us, and as you will see, you should be able to see the PowerPoint presentation on your screen. So at this time, I'd like to hand it over to Mr. Frank. Okay.
Anyway, I'm going to walk everybody through our corporate presentation today, which you can find on our website, and we do update this presentation on a monthly basis. I will be making forward-looking statements during today's presentation. Today I'm going to walk you through what I believe are 5 compelling reasons on why you should look at Seabridge as an investment opportunity in the gold space. First is our proven and probable reserves, which are very high ranking in terms of the other companies in our space. Second, we have one of the lowest, if not the lowest, share count in the industry in terms of shares outstanding. Third is right now today we're trading at a relatively low valuation compared to peer group companies. Fourth is the concept of political risk. All of our reserves are located in Canada, which we believe is one of the safest jurisdictions in the world. And last but not least is the exploration upside we're now seeing through new programs that are underway at KSM and recently completed at our Courageous Lake asset. In terms of reserves, most people are surprised to see that we have more reserves than Yamana, Agnico Eagle, and other much larger companies. In fact, our reserves of 45 million ounces put us in the top 10 in the world in terms of gold reserves. I believe what really sets Seabridge apart, however, is the low share count that we have. From day one, which was in 1999 in the case of Seabridge when we founded the company, we have endeavored to try and increase our ounces on a per-share basis each and every year. If you look at us today in terms of reserves, each one of our shares is backed by nearly 1 ounce of gold reserves in the ground. This is 5 to 10 to 20 times greater than any of the companies in our space. I believe that one of the biggest risks we all face as investors in mining stocks is the risk of equity dilution. Our business plan was based on the concept of growing our ounces on a per-share basis. We started Seabridge in 1999 when the gold price was trading well below $300 an ounce. We believed that the price of gold would go significantly higher over time. And in the early years, we started to buy advanced stage ounces or projects in North America. From 1999 to 2002, we looked at well over 200 different projects held mostly by the seniors and wound up buying 9 deposits that initially gave us 15 million ounces of gold resources. By the time we finished those acquisitions, we had about 28 million shares outstanding. So with 15 million ounces in the ground and 28 million shares, each one of our shares was backed by about a half an ounce of gold in the ground. As the gold price started to move higher in 2003, 2004, 2005, we then moved to the exploration phase of our business plan, which was to try and grow the projects that we had acquired through exploration. And we were very fortunate that 2 of our projects, KSM in British Columbia and Courageous Lake in the Northwest Territories, has allowed us to grow our ounces from the 15 million ounces we acquired in the early years to over 80 million ounces exiting 2012. During that same time period, our share count grew from 28 million shares to about 46 million shares ending 2012. So you can see from this graph here that not only did we grow the ounces, but we significantly grew our ounces on a per-share basis. And it's not just growing the resources that were important to us. As the price of gold moved higher, ounces that in the early days may not have been economic all of a sudden became economic ounces. So during this process, we also endeavored to convert resources to reserves by completing pre-feasibility studies as well as permitting activities to show that these projects could be very profitable mines in the current environment. So if you look at Seabridge today, we have 1 ounce of gold reserves on a per share basis and another 0.8 of an ounce or so on top of that in terms of resources. Nobody in our space comes close to that. In terms of valuation, we're on the low end of the spectrum right now. We trade at about $14 per reserve ounce. Now, we recognize that most of these companies on this chart here are already producing, so they should have much higher valuations per ounce. But when you look at Seabridge relative to other peer group companies like NovaGold, Gabriel, that do not yet have producing mines, we still trade at a significant discount to these companies. We know that one of the most meaningful things that we can do to raise our market valuation is to complete a strategic joint venture with the right partner, under the right terms, at the right time. And that's something we're working towards with the work now underway at KSM and at Courageous Lake. Next concept is political risk. We're all seeing the challenges that some of the big companies are facing in places that were thought to be safe in the past, but are now being challenged either through a creeping expropriation, through rising royalties or taxes, outright expropriation, or local opposition resulting in big delays for large projects. We believe that Canada is one of the stablest jurisdictions in the world with one of the best tax regimes. We believe as the big companies go forward, as they look for new opportunities to build and operate, which they have to do, they will start to focus more on political risk than perhaps they have in the past. And that puts us in a very good position. Turning now to our first major asset, the KSM project in northern British Columbia. This is a project we acquired from Placer Dome in June of 2000. It was when gold was trading at about $2.70 an ounce. Copper was trading at about 60 cents a pound. When we bought this project, only the Kerr and the sulfurets deposits were known, which at that time were modeled at 3.4 million ounces of gold and 2.7 billion pounds of copper. Through our activities, we've now increased these resources here by adding the Mitchell deposit and the Iron Cap deposit to where this is now the largest undeveloped gold reserve in the world. We have completed 3 iterations of pre-feasibility studies. We've now spent about $170 million to advance this asset in exploration, engineering, and permitting, and we're now well on our way to be able to demonstrate what will become one of the largest mines ever working in Canada. In terms of size, KSM is larger than anything that's ever been owned by Barrick, Goldcorp, or Newmont. It is, in fact, the largest undeveloped gold reserve in the world today. Here's a photo of what you're looking at in terms of topography. This is the Mitchell deposit, which we discovered in 2006, which is now the largest gold deposit ever found in Canada. And this is where mining will begin at the KSM project. We have a lot going for us in addition to the large size of the project. We also have very favorable logistics at KSM. In British Columbia right now, the government as well as the federal government are now extending the power grid up Highway 37, which runs just to the east of our project. This power grid that is extended up Highway 37 will allow us to tie in and buy power at about 5 cents per kilowatt hour. If we had to go in and build our own power plant for an operation like this, which a lot of the large undeveloped gold copper projects around the world have to do, we will be spending at least $1 billion of capital to build it. We don't have to do that here. The government is providing the power on the grid right past our project. And if we were to build our own power plant, we'd be generating power at about 15 cents per kilowatt hour, whereas we can buy off the grid for about 5 cents per kilowatt hour. This gives us huge advantages over other projects, being able to buy power at a very low rate. The second favorable logistic for KSM is the proximity to the Port of Stewart. Stewart provides year-round port access to the Pacific Ocean. We can have large ships that bring supplies in and take our concentrate out on a weekly basis. And then last but not least is the road access. Just to the north of us at the Eskay Creek project, Barrick shut that mine down 3 years ago. The road access from Stewart is still available there. And just to the south of us was an old mine that was operated by Newmont back in the 1960s called Grand Duke. So people say that this isn't a tough environment. In fact, it isn't. Having close proximity to roads, close proximity to a port facility, and most importantly, close proximity to cheap power makes this project very, very attractive. This is just a slide that shows how the mine would be built. We have two sides of this operation. To the west is where the 4 deposits would be mined sequentially, and then to the east is where we would have our milling facility and our tailings management facility. We'd mine the product in the Mitchell Valley. It would be crushed in the Mitchell Valley, then transported by conveyor in a tunnel to the mill site. And at the mill site, we would make a gold-copper concentrate, a gold-silver doré, and a moly concentrate, which would all be shipped out by road to the Port of Stewart. Total capital costs for this project are estimated at about $5.3 billion. But once those capital costs are made and the project is up and running, this project has a mine life in excess of 50 years. In terms of grade, we're also fortunate that the first 7 years of mine life have a higher grade than the life of mine average. This is helpful in terms of recouping your capital quicker. Getting higher grade through the plant in the early years results in higher cash flow, which means quicker paybacks, better internal rates of return, and higher net present values. Looking at gold production during the first 7 years of mine life, this mine produces over 800,000 ounces of gold a year and nearly 200 million pounds of copper. The pre-feasibility study that we completed in May of last year shows a very robust project at 3 different cases. The base case, which is what the Securities and Exchange Commission in the United States requires that we do our economics at, uses a 3-year metal price average look back. So the gold price then was $13.30 on a 3-year look back, copper $3.45, silver $25.20, and molybdenum $15. What jumps out at you on this base case is that this project has very low operating costs. The operating cost net of byproduct credits is about less than $150 an ounce. And the total cost, which includes the upfront capital of $5.3 billion, the sustaining capital over the 55-year mine life, and the closure costs, still shows an all-in cost of about $600 an ounce. If you use more conservative metal prices, it's about $700 an ounce. This is a very capital-efficient project. If you compare this to what the majors are making now in terms of all-in costs, they're all reporting about $1,100 to $1,200 an ounce. This project would produce gold all in about half of what the majors are producing gold for today. We have also spent a lot of time through the permitting and First Nation studies. We've started the process in 2008 when we filed our project description document. Earlier this year, we've now filed a formal application for environmental assessment as well as our environmental impact statement. We've now gone through the screening and pre-screening process, and we're now in the formal review process. We believe that this project will be approved by the regulators, both provincial and federal, sometime mid-2014. That is a major de-risking that will help with any ongoing discussions with joint venture partners. What really excites us about KSM, however, is the new exploration results we're now seeing at a number of our existing deposits. Last year, based on some better geologic understanding, we now have 7 years of data that was also supplied to us by our next-door neighbors, Bruce Jack Valley of the Kings project, held by Pretium Resources, where we believe we can actually find some higher-grade feeder zones, or what we'd call potassic core zones, underneath our existing porphyry deposits. Last year, we started to look for these, and by the end of last year, we believe we had found one underneath our Kerr deposit. We've now gone in with a 30,000-meter drilling program in 2013 to try and define resources underneath our Kerr deposit. Just a couple of weeks ago, we announced the results of our first 3 holes underneath Deep Kerr. This is a plan map of the Kerr deposit, which is one of our 4 deposits that will be mined in the sequencing of the project. If you look at the project in terms of cross-section, looking at what this looks like at depth, what we were hoping to find was this high-grade potassic core. Think of this as the roots of the system that provided the access of the metal to the surface deposits that are now expressed at the surface. You can see here that some of our drilling over this past year already has encountered much higher grades than our existing reserves. In fact, the material we're now encountering at depth underneath the Kerr deposit is about twice the average reserve grade of our existing reserves. That is very, very important. Also, the benefit of this deposit here underneath Kerr is that we believe we can access this from the valley floor of sulfurettes through a block caving operation. Just some of the cross sections you go through. Here you see an intercept of about 123 meters of 0.86 gold and 0.85 copper. To put that into perspective, the average reserve grade at KSM is about 0.55 gold and about 0.2 copper. So you're seeing nearly twice the gold grade here and 4 times the copper grade. Being able to move higher grade material into the sequencing of the mine in the early years will have a huge positive impact on the overall economic projections and results of this project. Kerr is not the only deposit where we believe we've now found a deep core zone. We also started to look underneath our Iron Cap deposit, which is our northernmost deposit at KSM. And just a couple of weeks ago, we announced the results of our first couple of holes at Iron Cap. Iron Cap is a deposit that we mined entirely as a block cave towards the end of the project life. However, what we're seeing now underneath our existing reserves that are expressed on the slide as those blocks with colors in them, underneath that deposit, we are finding some significant grades in terms of gold and copper. We will continue exploration this year. We now have 6 drill rigs at KSM, 5 of which are drilling up an initial resource at Deep Kerr, and 1 of which is now following up on the success we've seen at the Iron Cap deposit. We're not just a one project company. We also have a second large project called Courageous Lake, a project that we acquired in 2002 from Newmont and Total Energy from France. We've now last year completed our first pre-feasibility study at Courageous Lake that showed a project that could be mined as a large open pit with decent grades. The project is located just south of the 2 large diamond mines in the Northwest Territories. This is helpful to us in terms of giving us real-time numbers in terms of what it costs to operate in an environment like this. The pre-feasibility study that we completed was on the FAT deposit, which sits about 2 kilometers of the strike length of the deposit. We have control of an entire greenstone belt here, which gives us a strike length of nearly 53 kilometers north to south. And just to the south of our FAT deposit were 2 higher grade deposits that were mined in the 1960s called Salmida and Tundra. If you look at Courageous Lake, the results of the preliminary feasibility study completed last year, it shows a project that needs a fairly high gold price or higher than it is today to really provide robust economics, or somebody would go in and spend the $1.5 billion of capital to build it. So this project is leveraged to the price of gold. At the all-time high in the gold price, it shows a very robust internal rate of return and relatively short payback period relative to mine life. At today's gold price, no question, it's not a project that people would put dollars into today. So as a result of that, we turned to this, we asked ourselves, what can we do to improve the overall project economics? We're now looking at a potential hydroelectric power source, which would reduce the power cost considerably and perhaps lower the operating costs by as much as 1/3 as they now stand. We're also examining and working with the provincial government on potential year-round road access that would provide better access to the project on a year-round basis. But the most impactful thing we're doing now is looking for higher grade material. In that we control an entire greenstone belt, finding higher grade zones that could be processed in the same mill that will be built for the FAT deposit would help in terms of paybacks, internal rates of returns, and other economic projections. Earlier this year, we set out to try and infill a second deposit we have called Walsh Lake. We've now completed an infill drill program that is showing a deposit that may be twice the grade of our existing reserves at FAT, but more importantly, the metallurgy here also is very good. The metallurgy at Walsh Lake is far simpler than what we see at the FAT deposit. We should have our initial resource calculated on Walsh Lake sometime during the current quarter, and then we can start to look at what would a deposit like Walsh Lake mean to the overall economics for Courageous Lake. So as we look forward here, what's going to drive success in the marketplace? One of the big de-riskings we can do for the project is to have the KSM project approved through the regulators. We are now well down the track on that and believe we'll have the project approved by the regulators by mid-2014. Second is exploration success. We are now drilling off zones at both projects, which are significantly higher grade than our existing reserves. As that becomes more real in terms of being able to quantify resources and reserves from that higher grade material, that will improve the overall economics for the project. And then last but not least is to complete a joint venture with a suitable partner, first at KSM. The de-risking we're doing through the environmental assessment process, through negotiations with First Nations and treaty nations, will make this project that much more attractive to the majors. In fact, a few weeks ago, one of the top treaty nations at KSM, called the Nisga'a Nation, jointly announced with us that we've made significant progress in negotiating the key elements of an impact benefit agreement. Being able to show that we have agreements in place with First Nations will make KSM far more attractive to any major looking at this opportunity. Just to kind of sum up from a corporate perspective, we are listed on the New York Stock Exchange as well in Toronto, although I will say that most of our volume occurs in New York. About more than 90% of our shares are traded in New York. Our daily volume is about 500,000 shares a day or more right now, so liquidity is good. Our share structure is tight. We have 45.5 million shares outstanding, 48 million diluted. Our balance sheet is strong. We don't have any debt. We have more than 25 million in cash. Insiders own more than 30% of this company, which I think if you look at most companies in our space, that is a very significant inside ownership group. We also have strong institutional ownership from large, long-standing shareholders and a strategic investor in Royal Gold. You can go to our website and get a better sense of the management team that we have in place. What I will say is that I believe the management team that we've assembled here at Seabridge are second to none in a company our size. All of our senior management have been involved with projects and large companies in their more than 30 years of career, companies like Newmont and Placer Dome. We also have a very strong board of directors that has a strong industry experience, both from the technical side and the financial side and the exploration side. With that, Peter, I'll turn the microphone back over to you.
Okay, thank you very much, Rudy. Appreciate your presentation on Seabridge Gold. For those who would like more information, please visit the website. And in your chat window, you can also see a link to a report that Simon Russell, the goldseek.com mining analyst, and myself put together, a technical review and fundamental review of Seabridge Gold. I also had the pleasure of visiting the site, KSM, just over a week ago, and we'll be presenting those findings at the Toronto show later this week, as well as a public report in the coming weeks. We had a couple of questions, Rudy, if you don't mind sticking around for a couple questions.
Be happy to do that.
Great. So we have a question from Keith from Canada, and he's would like to know, would it make economic sense for Seabridge and Pretium to build a mill together, or that they could use together? And would it make sense to do some sort of joint venture, since it seems with the geography between the mines is conducive to such a joint venture?
Good question. A question I'm asked a lot, Keith. Thank you. The fact of the matter is we're looking at apples and oranges there. The deposit that Pretium has is a very high-grade, small deposit in terms of throughput. They're looking at a project that would probably be processing maybe 1,000 to 2,000 tons per day. If you look at the KSM project, it's a project that is huge, that we processed at the rate of 130,000 tons per day. There really is no middle ground where you can process both ores at a similar plant. So they really are unique beasts.
Great. Our next question comes from Mr. Wolf out of Germany. Regarding your two discoveries below Iron Cap and Deep Kerr, how long will these access tunnels have to be from the valley floor to these discoveries?
Yeah, we're still in early stages there, Mr. Wolf. We need to do a lot more drilling, which is now underway at Kerr with 5 rigs. We believe, though, if you look at it in terms of just the long cross-section there, you can basically take and add it in a couple of kilometers from the valley floor of sulfurettes and have access to the higher grade zones underneath the existing Kerr deposit.
Okay.
In terms of the Iron Cap deposit is a lot closer to existing infrastructure in terms of our tunnel as well as our crushing plant, and the access even the deeper portions of iron cap can be had through the Mitchell deposit.
Great. He also had a second part to the question. It says the current mine plan asks for the development of iron cap in the Kerr deposits very late in the mine life, year 27 and 32. Assuming a high enough tonnage of these two ore bodies, would these two underground block caving operations contribute ore earlier in the mine life? Or do you have any considerations of how big these two ore bodies have to be in order to change the plan and development of them earlier?
Again, early days to be designing mine plans around this deposit. The drilling that we're going to do will help in terms of quantifying what the size and shape of these deposits are. Right now, we believe that they will be very large. If you just look at the geometry of Deep Kerr, that could be a zone that hosts up to 500 million tons, which is about a little more than 10 years of additional mine life. Sequencing of these additional deposits into the mine plan will take time. However, we believe that because the grades are higher, that perhaps they could be moved up in the sequencing from where those deposits are now to help the overall economics for the project.
Great. Well, thank you for your time today in presenting to the GoldSeek audience. For investors, again, who would like more information, please visit their website, seabridgegold.net. And if you have any more questions, feel free to send them over to us, and we'll send them over to the company. So, again, thank you for your time today, Mr. Frank, and look forward to having you back on another presentation soon.
Peter, thank you very much for the time.
All right, thank you. So at this time, we'd like to switch over to our next presenter. Our next presenter is Jim Willie. He is one of the most popular GoldSeek authors. Recently, his article on Syria pipeline politics, OPEC and the U.S. dollar, back on August 30th, had over 35,000 people who read that article. Went quite viral. Over 1,500 people on Facebook alone recommended and shared that article. So at this time, I'd like to hand it over and have Jim begin with a little presentation, and then we have several questions from the audience that we'd like to present to Jim. So at this time, I'd like to introduce Jim Willie. And Jim, if you're ready at this time.
I'm ready at this time.
Okay, great.
Okay, I'm searching through a couple of charts. I'd like to show a particular chart if I could. Show my screen. Okay. I'm sorry, I'm working on something here. Okay, show my screen. Let me size this. Okay, can that be seen properly? I have the gold price versus COMEX inventories and ETF holdings.
Okay, let me just see if...
Okay, as preface, let me just say something that we're at an extraordinary time in Western and global history, in particular American history, U.S. history. We've got an intersection right now of U.S. monetary policy being intermingled with U.S. military policy. And there's been kind of a joke in the last 5 years that since the United States government doesn't have any gold reserves, Fort Knox is empty. The joke is that the U.S. dollar is backed by the military might. We're starting to see that evident in a very painful and extraordinarily dangerous way right now with Syria. Let me just double check. Peter,
yeah.
Is my sound okay?
Yeah, your sound's great. You're coming through great. Your chart is showing. So.
Yes?
Yeah.
Oh, it is showing. Okay. Well, let me just finish my preliminary points. The Syria mess has the risk of turning into a very serious war. The United States needs wars. They need wars to take away rights, to firm up banker power, to distract the world into thinking that their security is at stake when the ones doing the attacking are largely the U.S. security agencies, and that's evident right now in Syria. The whole Arab Spring movement has destabilized all of North Africa, And it's going to eventually have a very detrimental effect financially with working to topple the Saudi regime. And that's the home, the center, the core of the petrodollar. The Syrian mess right now, the battles going on, are to prevent a pipeline from hitting the port and finishing construction from Iran through northeast Iraq into Syria and to the Mediterranean port. The big issue for the United States right now is they want to prevent Europe from being dependent or even a customer of Iranian natural gas. They want to prevent Western Europe from being a captive of Gazprom and its just extensive pipelines into Asia, into Southwest Asia, into Eastern Europe, into Western Europe, and Gazprom even extends into Great Britain. So if these pipelines are completed, I don't mean just Iran to Pakistan and China, but if Iran gets the pipeline, I call it the Shiite pipeline because it's not under the Sunni control, which is the friendly side of the Arabs. It's the more violent Shiites in Iran and Hezbollah and Syria and Lebanon. It's an absolute mess. But if the Iran pipeline hits Syria, creates a port, becomes available through Gazprom for Western European markets, the rub for the United States is that Western Europe is going to turn its back on the United States, not just the dollar. They're going to turn its back on U.S. government policy, which has been for quite a while mixing subterfuge and nefarious deeds with dollar defense. I believe that a phone call was made last week between the Gazprom officials who have offices in the Kremlin, in Russia, Moscow. Gazprom called Cameron in London and told him not to back the United States in Syria. This is getting very, very serious. And, you know, an interesting parallel is that for 5 years the United States, through the central bank, the Fed, has had no exit policy, no exit strategy, no exit opportunity from 0%, which back in 2009 I said would remain forever, and that's turned out to be a correct forecast. Then in 2010, when they were talking about quantitative easing in bond purchases, I made another forecast and said that QE would go on forever. It wouldn't be temporary. It would be forever because there will be very few buyers of U.S. Treasury debt. Now we see the 0% permanent. We see the bond purchasing through monetization permanent. And the U.S. has no way to get out of this. So the parallel is that the Fed is stuck with 0% and QE, and the military is now stuck. They're damned if they do, they're damned if they don't, regarding Syria. We're losing credibility, and the United States is gradually being isolated. This all turns into a gold play, though, because what's in progress, in my opinion, through Syria is the death of the dollar. The U.S. military is seeing a last opportunity. Actually, it's the Wall Street bankers using their military arm as a last-ditch defense of the petrodollar, because the Gazprom natural gas pipeline and the co-op, I call it the Nat Gas co-op, it has some strange bedfellows in it, like Turkmenistan, Israel, Qatar, Iran. These are very strange bedfellows. They're all working with Gazprom of Russia. What's coming online soon is the eclipse of OPEC and the fading away of Saudi power. And the alignment will disappear between the Saudis and the United States. The petrodollar is going to fade away. Natural gas is going to take over importance on a geopolitical basis. And that, I believe, is going to foster some tremendous shockwaves in the financial world where treasury bonds are going to be divested, converted to gold. We're very close to the point where the dollar is going to lose its petrodollar foundation, its platform. the basis of global trade, or predominant global trade, but definitely most of crude oil trade, great majority of crude oil trade. We're going to be moving toward a different system where a lot of different countries, and it's going to approach a critical mass very quickly, are not going to trade in the dollar. They're not going to settle trade in the dollar. We have Iran, Turkey, China, and India all working now to establish gold-based trade settlement. And this is going to be the second shock wave. It'll be the loss of the petrodollar with Saudi support, loss of U.S. protectorate role in the Persian Gulf. It'll be shared by Russia and China soon. Decisions have already been made. And then we move toward gold trade settlement. This is how gold will get to 3,000 and make quick moves to 5,000 and 7,000. The end of the petrodollar, the end of dollar trade settlement, the end of the global reserve U.S. dollar, the end of treasury bonds across the world as reserve systems, the foundation for banking systems. The graph I have here shows in vivid form how the COMEX inventories and ETF holdings are all being drained. And it points out that the German repatriation request was a primary event. That was late last year. It was about December or November. I don't know, I have the exact date, but it was about 8 or 9, 10 months ago. Everything changed after that. I won't get into things like, the Mali war to provide supply for Germany by England and France. That's the kind of stuff where it proves my point that monetary policy is being mixed with military policy. London was so desperate for gold that they saw fit to attack Libya and the embassies so that, pardon me, Gaddafi being dead, disemboweled in a culvert, could not go to London to claim his 144 tons, which London needed more than Gaddafi did. So the mix of monetary policy and military policy is becoming quite ugly evident now, and we see the COMEX inventories being drained. We're getting really close. I don't have any idea when. It could be months, could be several months, could be a year, but I think it's going to be more like several months. The COMEX is going to stop offering gold futures contracts and will no longer be in the business of gold price discovery. In other words, the price will be set elsewhere. I think we're going to have a dark period, but shortly after, like 30 to 60 days after, it'll be quite clear what the gold price is, because you'll have 5, 6, 8 different centers around the world that are gold trades, where gold is trading avidly, and they're all going to kind of put forward their best price, and it'll all be averaged, and you're going to get some kind of a LIBOR type of average. LIBOR is an average of various prices. It might drop the lowest and drop the highest or something like that and average the rest, kind of like an Olympic gymnastic competition judging. That's what LIBOR is like. We're going to see the same thing in gold in the next year or two, and when we do, it's not going to be under 2,000. So Peter, that's my spiel on what's going on with Syria and how it relates to the dollar, the petrodollar, gold trade settlement. The natural gas pipelines are not going to settle in dollars. That's why the U.S. government is trying to block the advance of the ports for the gas pipelines in Syria. This is the end of dollar-based trade. This is the end of the the end of the dollar reserve currency role. This is the end of treasury bonds in banking systems as reserve foundation. The end of the petrodollar. We're at crossroads here, folks, where it's extremely dangerous. The vile, corrupt bankers will not go quietly into the night.
Okay, well, Jim, can we field a couple questions, several questions?
Sure, fire away. I can't guarantee any preparedness for the answers, but I do okay winging it.
Okay, we've got several questions, and let's start off with this kind of topic on Syria and Gazprom and Saudi Arabia. We've got a question from Kevin. Kevin's asking, Will the House Assad survive the current Mideast turmoil and keep the petrodollar alliance with the U.S. alive? If so, for how long?
I think definitely not, as in hell no, not a chance in hell, no way. First of all, you've got some very weird events going on in Saudi Arabia. It was reported last September that Prince Bandar, a.k.a. Bandar Bush, was assassinated. The Saudis are assassinating Syrian officials, ministers, like the brother-in-law of Assad. They've got a very big hand in what's going on. Hezbollah, on the other hand, is the Shiite violent arm in Lebanon and Syria. Well, they've done some retaliation. It was reported that Bandar was killed. Now Bandar is making trips to Moscow, and I wonder if it's really his brother. I wonder if it's one of his 86 half-brothers. These guys breed like frigging bunnies. They've got 6 wives. They've got 1,800 grandchildren. So I have no idea who Bandar is who met with Putin. On the other hand, in February or so, King Abdullah was reported to be clinically dead with all of his organs, his brain, his liver, and other various organs. So he was reported as being in a meeting in Tunisia 2 weeks ago. Was that really him, or was that a double? Okay, that's just some of the strange things at the leadership. Now, I've got a great source who's got Middle East connections. I call him the voice, but he's got connections in Dubai and the Persian Gulf generally. He knows Saudi princes. He does some purchasing for them of gold. He told me back in April of 2010 that 200 different billionaire sheiks and princes and wealthy Arabs met and decided that Russia and China would provide the new protectorate role for the Persian Gulf. That was 3 years ago. With all the mayhem, chaos, and disorder going on right now with Arab Spring and other things in the Middle East and North Africa, I think all of this has accelerated. From what I'm hearing, and confirmed by things like a gigantic, 1 year ago, a gigantic petrochemical plant project between the Saudis and their Aramco corporate arm and the Chinese. It was to be built on the western side of Saudi Arabia. They've got oil wells out there, big petrochemical plant. The Saudis are getting tighter and tighter with the Chinese. If you look at the trends in the UAE and the Persian Gulf, like Qatar, Oman, Kuwait, etc., Bahrain, you see Chinese infiltration in commerce. I'm talking about purchasing malls, various department stores, other things like that. So the Chinese are already getting in tight with the Saudis. Iran, on the other hand, is getting in tight with the Russians. The Russians have a very big advantage militarily. It's not a broad, full-spectrum defense. It's a one-sided defense tactic with the Sunburn and the Onyx missile that is 1 generation ahead of the Tomahawk's cruise missile by the U.S. military. At the same time, Iran has very close relations with China and a lot of projects, joint projects for energy. Few people realize that something like 20% or 25% of the global oil reserves are in Iran. A gigantic slice of gas reserves are in Iran. Iran is not a small country. It's bigger than Iraq, and it's got 3 times the population. Okay, to answer your question, more definitively, the Saudis are on borrowed time. They've got 40,000 or so political prisoners, many of whom simply spoke out against Islam. We're not talking about trying to kill a prince. We're talking about just saying that they're tired of Islamic law throughout their society, so they're thrown in prison. Many of the top organizers are being murdered in prison. Expect disorder in Saudi Arabia to increase, not decrease, on a regular monthly basis. The Saudis are in a very tough position where they're trying to make peace and court the Russians and Chinese on one side. They're together. Russians and Chinese are always together. That's how they battle against the United States. On the other side, the Saudis are trying to maintain this relationship with the United States. If you're looking for the source of chemical weapons, it's through Saudi Arabia. It's their contribution to Syria. And I don't pay one bit of attention to the news because it's 90% lies, 80% lies. So Saudis are on borrowed time. As the pipelines continue with Gazprom, look for the geopolitical influence of Russia to increase. Those Gazprom pipelines will wrap a noose around the petrodollar and the U.S. dollar and capture like a lasso Western Europe as a commercial partner, and then come the political change of the guard decisions where you see things like Germany saying, we're not going to support your war, and by the way, we don't really support your dollar anymore. We're going to be working with Russia and China on a legitimate gold standard. So big things are coming. I don't know exactly when the House of Saud is going to fall, but I'm seeing the critical indications right now that it's just dead man walking. They're on death row. The Saudi regime, look for hundreds of princes to escape with their billions of pilfered national wealth to the coasts of Spain, because they like Spain. It's got good weather, it's got beaches, and you know, they can build their palaces there in peace and maybe buy up some cheap property. So that's the Saudis they're so cooked it's not even funny.
So our next question from Jeffrey is related to Syria. He's asking, could a war with Syria be used as an excuse to take the stock market down? And maybe just add to it, is it a smoke and mirror? Is it a smokescreen for the Fed's tapering coming up? Is this kind of timing-wise? Is there something related to this?
Well, it could be. I'll be honest with you. I pay very little attention to both the gold price and the U.S. stock prices. They're both fully managed, gold being pushed down, stocks being pushed up. The public in the United States needs for the stock market to be kept up so that they don't call their congressmen to complain about monetary policy. So the Fed and Wall Street decided a long time ago that when they pump up the money supply, they're going to make sure a good portion of it goes into S&P futures contracts to prop up the stock market. As for Syria relating to financial markets, I think we're going to see a direct effect between hostilities, conflict, and just basic stress geopolitically in Syria versus, you know, with respect to all the parties in opposition, whether it's Russia, China, United States, Western Europe, or whatever, Saudis. Saudis have a very big role there that's not in the news. They're running this whole thing in Syria. Which is incredibly weird because they're operating side by side with Israel. And it's just incredibly strange. These are not things that will continue. But as the Syrian stress level increases, look for foreigners to sell Treasury bonds and for the 10-year yield to rise. We made a run toward 3% a few days ago. I think it was Thursday, Friday. Back down a little bit now, like to 2.9. I made a forecast about a month ago that we're going to see 3.0% soon. I don't put time markers on this. Soon, and we're just about there. I think it was 2.97 or something like that. That will be the reason why stocks fall, because you've got this idiotic Fed valuation model that is very popular across North America and the investment community. It basically says that as interest rates rise, the stock average valuations must fall. And as the bond interest rates fall, stocks must rise. So even though the U.S. is stuck in this 5-year fierce recession bordering on a defined depression with no recovery in sight, stocks are up. And morons in Wall Street say, well, this is indicative of an imminent economic recovery. No, it's not. It's indicative of a permanent free money monetary policy. So free money is keeping the stocks up. War and threat of war is going to keep interest rates up, which will produce a great deal of instability in stocks. Stocks will be kept up by easy money and will be pushed down by rising rates. That's not a nice situation. I don't pay much attention to stocks. I think they're, a lot of investors are very interested in it. I'm just not. I'm focusing on the battle for the removal of the dollar. I'm focusing on the end of the COMEX. I'm focusing on gold trade standard coming in, not through banks, not through Forex, but through gold trade settlement. I'm focusing on the big paradigm shifts, and I'm paying very close attention to the 10-year yield on the Treasury bond. A very strange phenomenon. It's a channel has opened up in the last year or so. What started it was China with their African resource purchases. They'd buy a mine, who knows, they'd buy a big energy property in West Africa somewhere, pick your country, who cares, and they would buy it and acquire it with treasury bonds. The African nations taking the treasuries, they didn't sit on them and stuff them in their bank and say, oh, we're rich, we have treasuries. No, they cashed them in. They cashed them in to pay off their corrupt leaders. They cashed them in to feed their nation. They cashed them in to build communities, to build schools, build hospitals, build railways, build highways, whatever. So that's one way that the channel for treasury bonds has been heading back to London and New York for redemption. Another very big phenomenon has been Russian-Chinese commerce with energy pipelines, where the Chinese have already agreed we're going to pay in treasury bonds for all the gas and oil coming to China from Russia. Well, they're going to pay it in treasury bonds, and it's going to go straight to London for redemption. There's a big acquisition where Rosneft, which is twice as big as ExxonMobil now, Rosneft is the biggest oil company in the world. It's Russian, Rosneft, R-O-S-N-E-F-T. Well, they bought out the British Petroleum stake in something called TNK BP, BP for British Petroleum. The TNK conglomerate was bought out. So they're no more British in the Russian oil business, the oil sector. Well, what did they pay? Rosneft paid in treasury bonds. So lots of different channels are being stuffed now with treasury bonds, and I called it back in an article at the very end of July, I called it Treasury Bonds Return to Sender. So the redemption is going back to London and New York, who cannot refuse the treasury bonds. Now, if the treasury bonds went to the Bank of Italy, they say, screw you, we don't accept them, we have the euro. If you send them to France, they say, screw you, we don't do treasury bonds, we do the euro. You send them to Switzerland, they say, no, we don't accept them, we have the Swiss franc. But Britain is the warlord, the overlord, the banker lord, the owner of the Federal Reserve, and they call the shots in the United States and have done so for the last 100 years, their little American colony. London and New York will redeem all the treasury bonds, and I believe the QE from the Federal Reserve, the QE, the bond monetization, it will not taper off. It will double and triple. It will not go down. And any promise made by the President or the Treasury Secretary in the U.S. government for tapering to calm down the foreigners who want to abandon the dollar will be a lie. Foreign dumping of treasury bonds, which has been in very big volume in May and June, check the TIC report, the TIC, Treasury Investment Capital Report. Do a Google search on TIC report. Click up on some of the recent months, and you see historically high dumping of treasury bonds. In addition, you've got the indirect exchange with the Russians and the Chinese and the Africans dumping treasury bonds for whatever reason, because they have them in their hands from various large deals. The Fed has to lap it all up. Taper? I don't think so. The big story in the next 6 months is going to be how the Federal Reserve has doubled their monetization. And it'll all be coming out in very weird ways, proving Bernanke and his replacement and Jacob Lew, the Treasury Secretary, and the President, proving them all to be liars.
Okay, we got quite a few questions coming in, so we'll just try to.
I'll make them shorter. I'll make the answers shorter next time.
Sure.
We got a couple big ones there, though.
Oh yeah, absolutely. And what I'll do here in the chat window is share one of his latest articles on GoldSeek on Syria pipeline politics, OPEC, and the U.S. dollar, since there's quite a few questions regarding that. Our next question is from Tony. He's asking, Jim, do you have faith in the offshore, quote-unquote, offshore storage facilities for gold and silver, or is the if you don't hold it, you don't own it apply? Thanks.
I believe if you don't own it, you don't. I mean, if you don't hold it, you don't own it. But I extend that definition to honest countries, honest brokers. Dubai is an honest broker for vaulting services. Hong Kong is an honest broker for vaulting services. Singapore is an honest broker for vaulting services. Switzerland and London and New York are not. Switzerland is not. Switzerland is probably rampaging through lots and lots of bullion accounts. There are a lot of wealthy people in Central and Northern Europe who are very angry they can't get their hands on family gold in bullion banks. Do not trust Switzerland. They're in league with London and New York. Do not trust London. That's the center of global fascism. Do not trust New York unless you have an absent brain stem. So the answer, I believe, is if the nations have conflict and hostility and lack of cooperation with the U.S. government, they're generally safe places to do gold banking, bullion banking, vaulting services. I'm told by my best sources of information who have really good experience and really good connections and information and experience that Hong Kong is the best. And by the way, the Hong Kong capacity for vaulting at the Hong Kong airport is 10 times what they boast it is. That's how much they expect to get future business. And by the way, the Chinese have well over 10 to 15,000 tons of gold in their reserves. And the Russians have even more than that, on the order of 20,000 tons. The United States has 0.
Okay, our next question is related to silver. Jamie's asking, is it true that silver is or will be more rare than gold, and will the price of silver catch up to gold in price terms?
Well, first of all, gold is very common. It could fill I once heard that the statistic 200 meters by 200 meters by 200 meters, something like that, or maybe less than that. Silver is very rare. I mean, if you're wondering when is silver going to be more rare than gold, how about 200 years ago? How about 50 years ago? Silver was more rare 20 years ago. Silver was more rare 10 years ago. In fact, in 2006 or 7, the U.S. government drained its entire silver stockpile. So the government doesn't have any silver, they don't have any gold, but there's plenty of gold in a lot of different central banks, mostly on the Eastern Hemisphere, mostly in Russia and China. Okay, I made my point. Central banks don't have any silver, they have plenty of gold. Industry demands silver and demands a trifling amount of gold. So from a supply basis, silver wins. From a demand basis, silver wins. We have a situation where I believe for the last 4 years we've had acute shortages of silver, and we're approaching defaults. The entire MF Global incident in November of 2011 was over a silver default under J.P. Morgan management. So they decided not to deliver the silver they did not have, and instead to steal the accounts of all those standing in line for silver delivery. You know, I don't know where you're getting this information that silver is not statistic that's, I think, mind-boggling. If you take a look at just the 2012 and 2013 so far, silver coin demand volume, demand volume in Canada and the United States, just from the U.S. Mint and the Royal Canadian Mint, just for silver coins, and compare that with silver mine output for the two countries, U.S. and Canada, there's a 20 to 25 million ounce shortage, a deficit. So all industrial demand is in addition to the deficit of 25 million, 20 million ounces of silver. So Sprott made a great point a few months ago, Eric Sprott, that the output in mining across the world has 11 times as much volume for silver as they do for gold. And he reasons that's a good convergence point, 11 times larger for gold, 11 times smaller for silver. I think that's a great, great point. I don't look at the historical 16-to-1 bimetallic standard from the late 18th century or late 19th century in the United States. I don't give a hoot about stuff like that. I care about what's going on this century. I care about what's going on now. I don't even care about what happened in the last century, the 1900s, when I was a kid growing up. I care about now. We are going to see some very weird things happen with the gold and silver prices, and I expect, and I am told, by the way, I'm told with full assurance by someone who has an ear to the wall and contacts in meetings regarding the gold trade settlement developments with the G20 nations, the BRICS nations, the Shanghai Co-op nations, all led by Russia and China. I'm told that silver and gold will be the bimetallic standard for trade settlement. That when the conversions take place in this BRICS development fund, they're already changing it now to the BRICS Bank. Later it'll be called the BRICS Gold Processing Plant, because that's where treasury bonds will be sent from the emerging nations, Brazil, Russia, India, China, South Africa. They're going to take their trade surplus, they're going to take their banking reserves, and they're going to convert the treasury bonds into gold bullion, and it'll be the BRICS Central Bank. So the BRICS Development Fund will become the BRICS Bank, then the BRICS Central Bank, and then the Gold Central Bank for the new trade standard, gold trade standard. I believe we're going to see on the order of $200 to $300 for silver and on the order of $5,000 to $7,000 for gold. If gold gets to 7,000 or more, I think all bets are off for silver. It could go to as much as 300 or more. I think the ratio, let's just say silver is at 200 and gold is at 5,000. That's 25 to 1. Silver might be 300 when gold is 6,000. That'll be 20 to 1. We're going to be working toward ratios like that, Peter.
Okay. Do you have a couple more? Can you take a couple more questions, Jim? I know we're over our time, but quite a few questions coming in.
Sure.
Okay, well, this next question is from Hans, and it's regarding the bail-in law contained in the latest Canadian conservative budget. And he's wondering, although the bail-in provisions were contained in the budget proposals, has this law been passed in Parliament by Harper's government? And does the bail-in law include Canadian credit unions? And he's also mentioning that the Canadian credit unions do not have the so-called FDIC protection. Do you have any comments on that?
Oh, I have some loose comments. They're not definitive, though. I never try to portray myself as being expert at things I'm not. Let me give a preface regarding the bail-in programs. It came about with Cyprus. I believe Cyprus was a false flag attack. I believe the banks were shut down and a lot of accounts had a tax imposed. I believe that was a distraction because what the EU and the United States and the London bankers wanted to do was to cut off Russia and their usage of Cyprus, because the entire Russian banking system has as intermediary Cyprus banks. And a great deal of commerce and banking from Gazprom was done in Cyprus bank called Gazprom Bank. So I believe the Cyprus incidents were attacks to limit the progress and power of Russia encroaching on Europe through Gazprom and its pipelines. And it did not succeed. So what was the bail-in after all? I think it was an insurance policy. We know about the poison pill in various companies. It basically states, if you're going to do a hostile takeover of us, we're going to kill the company. The poison pill. We will, grant all kinds of extra shares to everybody under the sun who's a shareholder. The executives will give big options to all the executives. We'll sell off a bunch of property and assets. We will kill the company. So don't acquire us. I think there's a parallel with that, with the big banks in the West. I'm talking about Western Europe, England, and the United States and Canada. In other words, don't attack us for accounting fraud. Don't attack us for criminal bond fraud. Don't come after us with capital requirements. Leave us alone, because if you force our death, we will steal everybody's money. And that's not happened so far. Everybody's backing off the big banks. They don't want a bail-in. The people have demanded no bail-in. By demanding no bail-in, the people are saying, leave the big banks alone. They're too big to manage. They're too big to fail. They're too big to jail. Leave them alone. So the nations will approach, I'm talking about U.S., Britain, and Canada, will approach systemic failure. I don't know if it would apply to credit unions, but I will say this. It's really, if it does happen, it will only happen with the big banks that are involved with derivatives. And that includes, say, Toronto Dominion and the other big Canadian banks. It involves all the big U.S. banks. And I don't know about the mid-sized banks. I don't know. But I doubt that the bail-in provisions would go into effect for any credit union, because they're barred from any of these stupid derivatives. The derivatives, by the way, are a vaporous foundation. Imagine building a city on a cloud. Everybody lives on the cloud, and weight is born on the cloud, and the cloud has a city on it. That's how stupid the bank derivatives are and how deadly they are, and they're going to fail. There's no stopping the derivatives, and if you're wondering for a trigger on the derivatives that might bring about some bail-ins, the trigger will be the 10-year Treasury. It's approaching 3%. Small moves in the Treasury bonds yield will bring about great instability in the interest rate derivatives, the interest rate swap. The interest rate swap contract got into the news with the London whale back in May of 2012. It'll be in the news again. They're doing Herculean efforts right now to keep things calm. In fact, over the weekend, I got an email from a good source who got it from another good source to the effect that the news item was that the Federal Reserve and the big U.S. banks are now buying Treasury bonds among themselves to keep the prices up. They're dictating the higher price with the buyer, and that'll keep the price up. And that's how you're getting the bond yield go back down to 2.9 or a little bit lower. I don't know the exact yield today on the TNX, but just think of it as down from 3.0 to about 2.85 to 2.90. How did that happen? Oh, big demand. No, not big demand. More algorithm trading, more flash trading. We're getting more familiar in the last few years with how the big stocks and the stock indexes in the New York Stock Exchange have been kept up by algorithm trading in computers and by flash trading by Wall Street. They're basically selling the stocks to each other to maintain a higher dictated price. Now that has begun with Treasury bonds. So we're getting really close to derivative events. I call it Reich finance because back in Nazi Germany they put out a bunch of hokum regarding Reich physics and Reich chemistry and Reich genetics. They all favored the Aryan race. Well, now we've got the U.S. Nazis who occupy Wall Street and the U.S. Nazis who occupy Washington, D.C., and their various puppets and their controlling arms. They're trying to dictate that there's a recovery going on, that there's low inflation going on, that there's gold reserves in place, and the banks are stable. And none of the above is true. So I don't know about the credit unions, but I think if you're in a big bank in Canada or the United States, you better screw on your head properly and move it to a small or medium-sized bank. The smaller the bank, the better. I think the credit unions are probably the safest of all.
Okay.
That's it, Peter.
There's a follow-up question to that from
One more
Jeffrey
time.
regarding the bond market. He's asking, could it not be possible that the global stock markets be taken down and liquidated in order to support Treasury bonds as a quote-unquote safe haven, stabilize that market?
Well, that has been a pattern in the last 30 years, that bonds went down as rates went up and money went into the stock market as recoveries took place. We don't have a recovery in place. So you're not going to see bonds rise and bond yields rise. You're not going to see bond yields rise with painful losses to bonds and the money fly into stocks. What you're going to see is money fly out of bonds and go into gold. Again, I pay very little attention to stocks, and I feel sorry for people who do. I don't think it's the place to be. I don't want to get into a long spiel. I promised that I wouldn't. But focus attention on gold, on silver, on bars, on coins, and Hallmark jewelry. And I think that's the way to go. The upcoming pain and losses, I mean catastrophic losses, leveraged big-time losses, are coming with bonds, Treasury bonds. Just think of remember back in 2009, 10, and 11, and early 12, we heard about all the easy leveraged profits for the big U.S. banks who are replenishing their balance sheets with leveraged bonds, futures contracts. Borrow at zero, invest in the 3% Treasury bonds, because it's coming down to 2%, down to 1.5%. That's already happened. Now that's reversing. So all the easy leveraged Treasury bond carry trade profits for the big U.S. banks, it's all going into reverse now with catastrophic losses that the Fed is trying desperately to help them with. Pardon me. So where are the big U.S. banks going to put their money from redeeming the bonds? Nowhere. They're giant losses. So if you think there's a lot of money coming out of bonds that can go into stocks, I think you're clueless, because there was not a whole lot of money that went into bonds in the first place. They were from interest rate derivatives and futures contracts, leveraged derivatives. They call them derivatives. I call them just leveraged option-like trades. Treasury bond futures are not investments. They're gambles. They all went bad for the big U.S. banks, the London banks. They're not going to pull profits out to go into stocks because they're going to suffer catastrophic losses that kill their banks. There's no money that's going to go to stocks. These are massive trillion-dollar losses coming out of bonds.
Okay. Well, we'll have a final question here. This is from William, and he's asking about gold and silver, and he wants to know, what's the chance of a U.S. government confiscation of gold and or silver?
Well, this has been a question for quite a while. I think there's a better chance that they'll do gun confiscation. In fact, I've thought for a while that the gun confiscation was a test run for gold confiscation. The gun confiscation is not going very well. I've got a different opinion from most in the gold community. I want them to try to do a gold confiscation. I want them to try, because it will expose the value of gold. It'll expose the resistance of the people towards such thefts, and they won't go for it. So if they try a confiscation, it's going to be backdoor and hidden. Like, the CIA is already stealing gold and jewelry out of bank security boxes. Plenty of stories. There was the Fifth Third Bank out of Cincinnati, and recently there was an actual statement by the Central Intelligence Agency to the major banks that Get out of our way. Anytime we feel like it, we will rifle through your bank security boxes and take any gold, silver, jewelry, heirlooms, or coins. It is all legal within the Patriot Act, which I call the Nazi Gestapo Manifesto. So let them try. That's my attitude. I know it's probably not the attitude of a lot of people listening. They probably fear the confiscation. But if they try a confiscation, what percentage of morons in the U.S. community and Canadian community would comply? I think it would be under 20%. It would be the true moron crowd. Instead, people would say, it's time to move our gold coins and bars to the lakeside property where we've got a little hidden spot under the bathroom.
Okay, well, if there's anything else to add, we've got quite a few questions, Jim, left, and I think at this time...
I got time for more. Go ahead.
We've got a couple more? Okay. This goes back to the Middle East and Gazprom, and regarding the natural gas co-op in Gazprom, Gazprom selling only natural gas, but what about oil? You can't run cars on natural gas, so I guess the question is about OPEC and natural gas and power play there.
Well, let me bring a parallel regarding stocks and their value. We know the saying very well that the value of shares of stocks are determined at the margin, which means it's not your guy who owns 2 million shares who's got them locked up in a box and he loves the company and he knows the executives. He's not going to sell anything. That's not your margin. So the guy with 2 million shares, he might be a major shareholder, but he's not determining price. The same is true in the energy world. The core, the stable core, has been for a long time the oil industry, the oil supply. The margin has been with gas. Look at some of the, I don't even want to call them revolutionary, but look at some of the newer methods. I regard them as the new con jobs, like shale gas. Shale's a Ponzi. Some people will make money in it, but I don't recommend it because it's a whole nother debate. They have tremendously fast depletion and the great requirement for new wells, and eventually they run out of opportunity for wells and everything kind of falls apart. You get the major oil energy companies retreating from Ohio and Midwestern states right now because they're all losing money hand over fist. But the margin is natural gas. Look at the UPS delivery trucks. They may not have a great acceleration, but they don't need it. Occasionally they have to go up a good hill, so they go up slowly. The margin is being determined with gas. The margin is being determined with liquefied natural gas. The margin is being determined with shale gas and coal gasification and other innovative methods. But look at the growth of pipelines. And you see things like the Keystone Pipeline for oil is obstructed. Well, that might come online soon. It may be completed in its construction soon. I don't know. But if you look in Europe and Asia and the Middle East, all you see are gas pipelines. So the margin is gas. The clean, cheaper method is gas. You don't have the big residue in heating your home with gas. I actually didn't like gas heat when I was living in the Boston area because it was very dry. I would get cracked corner of the lips. I would have various lung problems. And a drier pair of lungs is more susceptible to a virus that arrives on water droplets. Anyway, that's a long story, but the margin is with gas. So who is controlling the incremental power players, the power pieces on the energy chessboard, and that is Gazprom. I mentioned the strange bedfellows of the Nat Gas Co-op. Qatar and Israel are the strangest of all. I mean, it's not unusual to see Iran, Turkmenistan, and Russia together. They've been doing commerce for thousands of years. Americans just don't realize that Iran has trading partners that are 1,000 years old. And the United States as a nation is barely over 250 years old. So the Nat Gas Co-op also has Israel as a partner, a participation player. The Tamar floating platform off Israel's coast recently made a deal, I think it was May of this year, May 2013. They made a deal with Gazprom to sell them all their surplus gas. Now, obviously, Israel is going to use the gas from the Tamar platform for their own economy. But it's a very large gas field. It's a very large platform. It's a very successful technological feat. This floating platform that doesn't have its anchor that can break and cause spills. So it's got this floating, flexible umbilical cord, and it's got the surplus going to Gazprom. So Israeli gas from Tamar is going to feed the European market. That's pretty interesting. The Qataris have a joint project from a giant discovery in the Persian Gulf. The Persian Gulf is not small. It's like a couple Great Lakes thrown together. So they got a gas find with Iran. Qatar and Iran are partners in natural gas production. Now, that doesn't address the Qatari contributions in the Syrian war, which makes for a real big mess and a tough balancing act for the leaders of Qatar. As Western Europe becomes more a dedicated Gazprom client for natural gas, you're going to see some strange things happen, like Russia telling Western European nations what to do. And it's all going to be done behind the scenes. Kind of like what I believe happened with Cameron in England, getting a phone call from Putin telling them that they're going to be cut off from Gazprom gas supply this winter in England for heating their homes in the cold weather months if they continue to support the U.S. military regarding Syria. Wouldn't it be interesting if in 6 or 8 months the various nations that have NATO air bases are told by Putin, now is the time for you to tell the Americans that they can no longer use the NATO Air Force bases to transport heroin. That's what they're doing. It goes from Afghanistan to Kosovo to Turkey to the NATO bases all across Europe off to England and North America. Back in 1990, 1995, 7% of heroin in the United States was from Afghanistan. Now it's 70%, up tenfold. So wouldn't it be interesting if Putin starts playing the natural gas, the Gazprom card in Western Europe? That's exactly what I think is coming. And as Gazprom and the Nat Gas Co-op get more influence and more power, you're going to see Saudi Arabia splinter away and maybe announce that the euro, the yen, the pound, and the franc, they're all acceptable for oil sales. And quietly they will accept gold, but they will not talk about it, because the Saudis want to convert to gold for their escape plan. Because they know it's going to be tough converting the treasury bonds. As the Saudi core weakens for OPEC, I think we're going to find OPEC totally irrelevant in the next year. Totally irrelevant in the next year, year and a half or so, when the climax events come. And you're going to see the rise of Gazprom and Putin calling shots behind the scene in Western Europe, not the London bankers. So a big paradigm shift is coming. Peter.
Okay, well, we'll do one final question here, and this one comes from Jamie. He's asking, what will the world look like by this time next year?
Oh, gosh. Oh, you saved the ripest one for last, huh?
Yes, indeed.
Well, I'll be honest with you. I take a lot of criticism, especially in '05 and '06 and '07. I started this newsletter in May of 2004, and I can't tell you how many hate mails I got telling me that I had no idea what the F I was talking about. I had no idea about U.S. dominance. I had these stupid ideas about housing markets, stupider ideas about the banking sector going insolvent, stupid ideas about weakening later on in the petrodollar and eventually the collapse of the dollar. All these stupid things that I thought, well, if you go to my forecast page, it's www.goldenjackass.com/forecast.html. You'll see a list of 17 or more correct forecasts that are all of this variety. As the dollar weakens, as the dollar gets rejected from isolation, as the petrodollar from its OPEC support fades away, as Gazprom takes over in geopolitical control at the margin in the energy world with natural gas, and the co-op eclipses OPEC, you're going to see the dollar split. The foreign banking centers that have a lot of dollars, namely Switzerland, Panama, Singapore, Hong Kong, they're not going to accept the dollar devaluation. They're going to force the United States to devalue a split dollar. And I'm hearing it's going to be called the U.S. Treasury dollar. I could go on for an hour about some of the history of that and some of the extreme subterfuge and espionage and really, really devious acts done by some former U.S. presidents in projects to collect gold across the world. Because they were planning in the late 90s to reinstall a gold standard for the dollar. But they decided instead to grant most favored nation status to the Chinese, to promise them help in foreign direct investment to build industries and factories, and to borrow their gold to buy another 5 or 6 or 8 years in the gold suppression game through gold leasing. They leased Chinese Mao Zedong era gold in return for the most favored nation status. Okay, that's now all turned sour since 2007, 8, and 9, when China has gone, which was another of my forecasts a while ago, China will go from trade partner to adversary to trade war opponent. Okay, that's another correct forecast I need to add to my list. Okay, as this plays out, the U.S. dollar, I think, is going to split and be devalued. And I think it's going to be a 30% devaluation, just to start. Various Asian entities have already requested that it be a 50% devaluation. Instead, they've made a compromise of 30% with a possible additional 30%. Divide that by 2 to find the price inflation shock impact to the U.S. economy. This is how I answer questions on what the U.S. might look like. A 15% sudden price inflation shock from a 30% devaluation of the new dollar, the separated dollar from the rest of the world. Think of it as the domestic dollar. 15% would take the gasoline price to $6, a gallon of milk to $6, and lots of different things, including services, would rise quickly. And I believe we're going to see violence at the 3 important supply locations across the United States. I'm talking about tens of thousands of locations that will see violence. Not 6 or 8. Tens of thousands of places that will see violence. They will be the supermarkets for food. There will be the gasoline stations for gasoline. And there will be ATM centers for cash. Just think of people robbing the others who have money, who withdraw money from ATM machines, robbing them of their cash, just like they've been doing for 20 years in downtown New York. I have experience with that. I have a friend who was robbed several times in Manhattan. from ATM machines. And the friend told me that the best time to do it is in the middle of the day when it's crowded. If you go in the evening, you're likely to get robbed. Okay, that's coming to the United States. So what will the U.S. look like? It's going to slowly transition to Mad Max. Supply shortages. Gangs roving in cities. Are people aware that in many parts of Detroit, the ownership is with packs of dogs? Roving packs of dogs are all over the bad centers, the dead centers, the decayed centers of Detroit. My worst fear, I think, is going to come when the supplies just don't reach the U.S. cities and you have absolute chaos and a lot of people dying. I'm talking about hundreds of thousands of people dying from not getting the supplies, from gasoline, from food. I mean, extend it to water. You think water is going to be easy in the cities? No. Those who've set aside a West Virginia or an upstate New York getaway, Shenandoah Mountains of Virginia, a getaway, those are the smart ones. Because they're not going to be easily accessed from the desperate urban dwellers where the supply lines are cut off. I think the U.S. is going to head into the third world. I've said this now for 5 years. I got laughed at in 2008. I got laughed at again in 2009. Curiously, in 2012 and 2013, I'm not being laughed at. I don't mind being laughed at because the people who laugh at me in the past are the silent ones in the future when many of the forecasts come to pass. I don't claim to be perfect. I just claim to have a lot of correct forecasts, well over 90%. The average among economists, the harlots of Wall Street, their average for economic forecasts, for correct forecasts, is about 20%. They're paid not to be correct. They're paid to support the system. So look for a lot of problems, and Western Europe is at a turning point. They can follow the U.S. into the sewer and the third world, or they can follow Russia and China and be part of the grand, huge Eurasian trade zone. So the U.S. is going to be isolated. They're going to be the last ones to fix their currency problems. They're going to be the last ones to liquidate their banks. I said back 4 years ago, you want to start a solution, liquidate the big banks. Next thing we do is we see the too big to fail. They're not too big to fail. They're too big to manage, and we will not tolerate their CEOs going to prison. They all belong in prison, all of them, the big banks. And, they've just converted crime into a business cost. I did a special report recently a few months ago on J.P. Morgan and all of their criminal settlements with the courts. I did an update, I think it was July or August, just a two-page item on J.P. Morgan and their recent court settlements and a summary of their last few years. Like $8 billion paid in court settlements and fines and penalties. Just minor business costs in the scheme of things. Narco money laundering for Wachovia turned out to be a fine of 1/30th of 1 penny per dollar of laundered narco money with the Mexican drug cartel. No, we're not going to liquidate the big banks, and now they've got an insurance policy of the bail-in. So the nation will go down with the big banks, but the foreigners, the Easterners led by Russia and China, will demand that the U.S. split their dollar, permit foreign-held dollars to stay foreign-held, and then you watch how difficult it is to get money out of the United States. The smart ones left already. I left in January of 2007. But I had motive. I had 2 death threats. Won't get into the details, but it made the decision quite easy. I had no family. I had no girlfriend. And now I have 5. All right.
Okay. I guess we can end on this note here. Could you share more information on your Hattrick letter and where the visitors can get more information on your newsletter?
Yes, if you go to www.goldenjackass.com, no hyphens, no periods in Golden Jackass, just one word, goldenjackass.com, you'll find a public web page, and it's not small. It's got, I think, well over 100 different links from articles and interviews in the last few years. It might have as many as 200 links going back, I believe, to 06 and 07. I've left them in kind of as a test to see, well, how many can it hold? Well, it takes quite a while to save, which means it's holding quite a lot. But there's a public page that shows articles in the public domain, and many of them have a GoldSeek URL address. There are a number of radio interview shows. I like to do them more. They're more fun. They're less solitary a project. I mean, I love writing and all, but I write the public reports. I write the paid reports for the Hattrick letter, which is what I'm leading to next. The Hattrick letter, all these different public articles and radio interviews, they're shameless promotional efforts to get people to sign up for my newsletter and pay me, or pay the business. It's a complex thing, but pay the business. I want paying subscribers. And every radio interview results in more. Every public article results in more. I mean, I've already gotten 4 new subscriptions today. I had 9 yesterday as a result of the public article and radio interviews. The Hattrick letter is comprised of 2 proprietary newsletter reports. These are not free, and they contain a great deal more information than my public articles, which, you know, some people say that, well, they're substantial, they're meaty. Well, they are. But I've got a lot of forecasts and derivation of forecasts, and a lot more analysis and laying out some constructs, a lot more information, a lot more side stories that are very interesting to paint the full picture. They're in the paid reports, and there are 2. One is called the Money War Report, and that's high level. That's for things like trade settlement and just various things on the petrodollar and the death of the dollar and just a lot of very important high-level things. Then there's a second paid proprietary report called the Gold and Currency Report. That's much more street level. That's about a lot of different stories, including things like coin demand from mints, and developments in India regarding their banking system and their rupee fall, blockades from duties, import duties, import blocks for gold coming into India. It's about central bank policy. It's about nuts and bolts of COMEX inventory, JP Morgan inventory, which is one and the same thing. It's about raids on GLD. So all those nuts and bolts, low-level things, not that they're low importance, they're just ground level, that's in your Gold and Currency Report. So the Money War Report and the Gold and Currency Report each come out 2 reports per month to the subscribing paying clients. So that's the newsletter, Peter, and you can find it on www.goldenjackass.com, and I hope some of the people here sign up. I've got different investment priorities. I really like gold and silver, but I prefer the coins and bars. But that's just me, and we'll see how that proves out over the last 5 years. Done quite well. In the next couple of years, I don't know. We may see a gigantic rise in the mining stocks. It's going to be very complicated because the big mining companies are short on supply. Just look at what's happening with Newmont and Barrick. They're short on supply. Their big mining companies, their big mining projects are having problems. Whether it's Pascua Lama in Chile on the Argentine border, or whether it's the what's the big one in Utah? I can't think of the name. Endicott? No, I can't think of the name. But there's a big project Rio Tinto owns in Utah with a gigantic mile-long mudslide. So the big mining companies have a supply problem. They have contract to supply COMEX. That's one reason COMEX inventories are down. The big mining companies have a problem. So they're going to go out and start acquiring. And I guarantee you they're not going to want to pay high prices for the little mining companies. I think there's going to be a flood of acquisitions in the next year by the big companies seeking to guarantee their supply again. So it's going to get really weird and complicated. But I hope some of the people listening here sign up for the newsletter, the Hat Trick Letter. It's this month will be number 114, which is amazing. Wow, 9.5 years.